Two people invest the exact same $7,500 a year in the exact same index fund for 30 years. Both retire with $850,000 on the screen. One of them keeps every penny. The other owes the IRS a six-figure bill. The only difference? A single drop-down menu they clicked when opening the account. Roth or traditional. 9 minutes, real numbers, and you'll know exactly which one is yours. An IRA, individual retirement account, is not an investment. It's a wrapper, a tax-protected container you open at any brokerage and fill with whatever you like, ideally low-cost index funds. As of 2026, the IRS lets you contribute up to $7,500 a year, or $8,600 if you're 50 or older. Inside the wrapper, your investments grow with zero tax drag, no capital gains tax, no dividend tax, year after year. The only question is when you pay income tax, on the way in or on the way out. That's the entire Roth versus traditional debate. Traditional IRA, you may deduct contributions from this year's taxable income. Put in $7,500 and, in the 22% bracket, you save about $1,650 in taxes today. The money grows untouched for decades. Then in retirement, every dollar you withdraw is taxed as ordinary income. You took the discount up front. The IRS collects at the exit. There's also a catch called required minimum distributions. Starting in your 70s, the government forces you to withdraw and pay up, whether you need the money or not. Roth IRA, no deduction today. You contribute money you've already paid taxes on. In exchange, everything that happens inside is yours forever. 30 years of growth? Tax-free. Withdrawals and retirement? Tax-free. Required distributions? None. It can compound untouched your entire life and pass to your kids. Run our example. $7,500 a year for 30 years at 8% grows to about $850,000, of which only $225,000 was your contributions. In a Roth, that's $625,000 of growth is never taxed. In a traditional, the whole $850,000 gets taxed on the way out. At 22%, that's a $187,000 difference in the IRS's favor. So which wins? One question decides it. Is your tax rate higher today or in retirement? If you're early career and earning modestly, your rate today is low. Pay the small tax now. Choose Roth. If you're in peak earning years in a high bracket, the deduction is worth more. Choose traditional and pay later at what's likely a lower retirement rate. Rule of thumb, low bracket Roth, high bracket traditional. Unsure? Roth is the more forgiving default. Tax-free is hard to regret, and Congress can't raise rates on money it can no longer tax. 3 fine print items for 2026. First, the Roth has income limits. Eligibility phases out between $153,000 and $168,000 for single filers, $242,000 to $252,000 married filing jointly. Above that, look up the backdoor Roth. Legal, common, one extra step. Second, the $7,500 limit is shared across both IRA types. It's one bucket, not two. Third, this is separate from your 401k at work, which has its own $24,500 limit. You can, and ideally should, fund both. Here's the truth the comment sections miss. The Roth versus traditional decision might swing your retirement by 10 or 15%. Not contributing at all swings it by 100%. The person who picks the wrong IRA but funds it every year for 30 years beats the person who spent 5 years researching the perfect choice. Open either. Automate it. The wrapper debate is a luxury problem. Compounding doesn't care which tunnel it grows in. Education, not financial advice. Your tax situation is yours, and a CPA beats a YouTuber. Next logical step, the 401k video, especially if your employer matches. That's an instant 100% return we cover right here. Subscribe for weekly money math without the hype.